Three biggest drivers of the bond market that we're looking at. There's a couple. The first one that I would say is the direction of monetary policy. The last few years we've come through a period where central banks were looking to tighten monetary policy, and that shifted towards the end of last year. So the direction of monetary policy and interest rates is now down. And it's not just here domestically with the RBA. We've seen it in New Zealand Central Bank, we've seen it in the US, we've seen it in Europe, different countries in Asia like Korea. So we're in the middle of a global monetary policy easing cycle now, and that's keeping interest rates anchored and supporting bond prices. So I'd say that's one of the big factors. The other one is a sort of a macro one that's very hard to judge at times, and that's just the shifting nature of volatile geopolitical relationships, whether that's China and the US, whether that's UK and Europe with Brexit negotiations. That uncertainty and volatility in geopolitical relationships is really holding back business investment, holding back growth, and also sort of dampening interest rates and keeping them anchored. And probably the last one I'd think about is a technical one, and that's just this really ongoing search for yield and income around the world, income producing assets. The level of interest rates so low, that's becoming more challenging, and this flow of money looking for stability of income and solid sources of real returns in assets. And you can imagine those three factors are all sort of anchoring interest rates. So we're sort of going through a period where interest rates are low and anchored at the moment, and I think that's some of the key drivers of that.